can buy flow-through shares and receive 100% tax deduction for every dollar you buy, and you can really drastically reduce your personal and corporate taxes. Normally it's 50 cents to give a dollar at the highest marginal tax rates. Using structured flow-through, we bring that cost to donate to as low as a penny, which is pretty incredible when you think about it.
Today we're discussing the intersection of wealth creation, tax strategy, and transformative philanthropy. Now, in 2026, successful business owners, they are looking for ways to preserve their assets and maximize their social impact.
Knowledge is power, so be curious. Pursue all these options that you have available to you. We're firm believers that people buy products from companies.
Hi everyone, this is Maheen and welcome to the CanadianSME Small Business Podcast. Today we're discussing the intersection of wealth creation, tax strategy, and transformative philanthropy. Now, in 2026, successful business owners, they are looking for more than just growth. They are looking for ways to preserve their assets and maximize their social impact. Joining us to discuss this is Jeff Todd, the VP of Marketing and Communications at Wealth. With over 13 years at the firm, Jeff has been instrumental in the journey that has facilitated over $350 million in donations and $2 billion in financing for Canadian resource exploration. So we've lots to cover in this interview, and without further ado, we'd love to welcome Jeff. Jeff, we're very pleased to have you on the show today. Welcome to the podcast. How are you?
Thank you. I'm very pleased to be here as well.
Now, Jeff, let's kind of begin our conversation with something that we we're anticipating this conversation to discuss, which is the mechanics of flow through. For those who aren't familiar, Wealth is an originator of structured flow through share model, which is quite a massive driver for the Canadian mining sector. Please tell us, why is this strategy the gold standard for financing critical mineral exploration?
Yeah, it's quite an interesting story, I think. I'm a little biased, but I think it's a pretty interesting story. But it kind of all begins in the 1950s. So the government recognized even then that Canada is incredibly mineral rich. We're very fortunate in terms of natural resources in this country. And so they recognized, well, how do we take companies at the exploration phase and seed them with capital so they can find the next gold mine or the next lithium mine or the next cobalt mine? It's very risky business exploration. So it's not easy to raise capital for those early stage explorations. And their answer to that was flow through shares, a super unique model. Unique to the world. I think they have a similar model in Australia, but a little different than ours, but overall very innovative. And essentially for every dollar that you buy of a flow-through share, you're financing a junior mining company in Canada. And for that, in exchange for that, you get 100% tax deduction. So they came up with this model to provide tax reduction to Canadians while also providing seed capital to an industry they deemed to be important. And it existed that way for quite a long time, again, beginning in the 1950s. What changed 20 years ago in 2006 is that we created what is called structured flow-through shares. And what makes those special is we're still seeding the junior mining companies, but we de-risked the transaction.
Right.
And so it's literally quite one of the ways you think of flow-through shares as seeding the junior mining companies with risk. And so you used to have a 4-month hold on those shares. So, in the 1950s and up to 20 years ago, you would buy the share, you get the 100% tax deduction. There's a 4-month hold. These are public companies on the Toronto Stock Exchange. And you hold on to those shares hoping that, you don't know if it could be a home run and it could do extremely well and they'll find something exciting, or they'll find nothing and they'll find just dirt and you could lose all your money. So that's the risk you would take. And you would hope that your tax savings would offset, whatever happened to the stock price, and then you could sell it in 4 months.
Absolutely.
20 years ago, though, we introduced the structured model. And that's really honestly revolutionized Canadian mining. It's most of Canadian junior exploration uses this structured flow-through model. And essentially what it does is when you buy the flow-through share, you're selling immediately to a liquidity provider. These would be hedge funds, Royal Bank Resource Mutual Funds, Eric Sprott's, high net worth investors. They're willing to take that risk from you the second you buy them. So you really have a GIC experience of tax reduction while also seeding Canadian exploration and mining. And so that's really become the gold standard now. Just recently at PDAC, I don't know if you know, but Toronto's home to the largest mining conference in the world. Very famous mining investor, Douglas Silver, recently did a speech. Northern Miner covered it, in which he said specifically that flow-through shares is responsible for the dominance of the TSX and for Canadian mining. So it's about north of 90%, 85, 90% of all junior mining exploration now uses this model to finance. And so where the small business community comes in is since 2006, we've worked with high tax Canadians to buy these structured flow through shares and reduce their taxes. So it's a real asset to entrepreneurs, to small businesses. It's a tax policy just like your RSP. It's actually older than your RSP. It's a tax policy just like your TFSA. Just as you'd want to use as much TSA annually as you can, just as much as you'd want to fill up your RSP, you can buy flow-through shares and receive 100% tax deduction for every dollar you buy, plus provincial credits and critical mineral credits that the government's now introduced. And you can really drastically reduce your personal and corporate taxes. You can either do that personally, or you can reduce your cost to donate. So you can, and that's where the philanthropy comes in. And so our clients use it for pure tax reduction purposes, but then they also use it to give to Canadian charities that they care about. And yeah, it's been a great run. We've been doing it for 20 years. We don't see it changing because the government is very bullish on our infrastructure projects. This is really a buy Canadian tax policy because you're helping Canadian businesses, exploration, helping Canadian charities, and along the way, if you wish to, you can keep a bit more, a few more dollars in your pocket through tax reduction.
That is impressive. It is very impressive how a targeted tax policy can act as a primary engine for an entire industry's growth. Jeff, let's explore how strategic tax planning turns capital into the large-scale philanthropy and community impact. How can tax-efficient strategies increase charitable impact without reducing liquidity?
Yeah, so essentially how it works is we've done over 800 of these transactions in the history of our firm over the last 20 years. Every month we'll have 3 or 4 of these financings for Canadian junior mining companies. And essentially what happens is our clients, many of them small business owners, they take part in the deal. And essentially you're buying the flow through shares. Our clients buy from anywhere from, we're very flexible. We'll do small purchases at $10,000, but some of our clients buy well into the millions. And essentially what you can do is you buy the flow through shares, you receive your 100% tax deduction, your provincial credits, etc. And then if you wish to, you can sell it immediately to the liquidity provider I had mentioned, de-risking the transaction. And so when you combine the money you receive back from the liquidity provider just a few days later, with all your tax deductions you're going to receive around this time of year in April, May, you can walk away with just a pure tax reduction strategy, plain vanilla, been doing it 20 years. It's a great strategy. However, a lot of our clients are philanthropic as well. So you don't have to keep that money from the liquidity provider. Instead, you can donate those shares to charity and unlock another tax deduction through the conventional charitable tax receipt. Now you can really fill up your foundation. And at Wealth, we have our own donor advised fund. And so essentially, our WCPD foundation would sell those shares for you. You get the money back from that liquidity provider, and now you have money in your WCPD foundation, our donor advised fund, ready to go to any Canadian charity that touches your heart. You know, everyone's got a different cause. Some people care about, childhood cancer. Some people want to give money back to their university, their alma mater. Some people want to give money to food shelters, things of that nature. And so by doing it with this strategy, you now have money in your WCPD foundation. There's no stock market risk whatsoever. You've eliminated that risk by selling it to the liquidity provider. And now you're going to get all those tax deductions come April, May. That's what brings down the cost to donate. Normally it's 50 cents to give $1 at the highest marginal tax rate. So if you were to give $10,000 to the local food bank, you could expect around $5,000 back on your taxes. Using structured flow through, we bring that cost to donate to as low as a penny, which is pretty incredible when you think about it, that you can bring down your cost to donate so considerably. So it's a great business because not only do we get to work in a very highly specialized tax policy that supports Canadian business, supports Canadian industry, but we also get to work with a lot of foundations and charities, which is a big part of my job. So when you bring down the cost to donate from 50 cents to give $1 to as low as a penny, people become a lot more generous. I like to say that we create philanthropists through its tax efficiency. But also, it allows people to stretch. And so we have clients that, maybe they can give $1 million, if they've done well in business. and they want to, perhaps put a name on a building in their alma mater, or maybe they want to remain anonymous. It doesn't matter. What matters is it really can make you a better philanthropist and stretch. And these days, we need more giving. We need more philanthropy. This is the golden age of philanthropy, and we facilitate that through tax efficiency.
Combining the fiscal responsibility with high impact generosity allows donors to really achieve naming rights and the legacies that would otherwise be impossible. So thank you for highlighting that, Jeff. Next up, let's discuss how proposed tech flow through rules could reshape venture capital in Canada. Please tell us, why is a shift towards technology policy critical for Canada's economy?
So this is what's really exciting about this. And I wonder, some of your listeners who are out there who maybe have never heard of flow-through shares, one of the most interesting parts of my job is really getting to kind of explain this tax policy to Canadians. There are, we've been doing this for 20 years. There are thousands of Canadians that take advantage of this structure every year, but it's always fascinating the number of people that haven't heard of it. And so it's a great part of my job getting to do it. And it's an exciting time for our industry because, yes, we've been doing it 20 years. Yes, it's had this remarkable success story in Canadian mining, but now we're looking at the possibility of flow through for technology. And that's so relevant to today's world. It's so important we buy Canadian. It's so important we support Canadian. But we all know that venture capital funding in Canada at the tech level is struggling. We need to support our Canadian technology entrepreneurs. So it was in the Carney plan. We don't know if it's gonna happen. Of course, we certainly hope it does, and there'll be amazing benefits to the Canadian economy if it does. But essentially, in the Carney plan, they're looking at piggybacking on the success of flow-through shares in the mining sector. Can this be replicated in the technology sector? We have an event coming up on April 21st in Ottawa at the Rideau Club. We are interested in moving it across Canada and doing it in other cities. It's in collaboration with RBCX. We have the permanent secretary at the Ministry of Innovation coming, and we have an amazing panel of entrepreneurs and policymakers really talking about this problem of how do we raise more capital for Canadian tech companies. We don't know exactly what the policy is going to look like. Will it mirror the mining side of things? Will it be different? But it's very exciting because really all we have to think about with flow-through is flow-through shares as a Canadian tax policy. It's seeding industry that we in Canada deem to be important. And how do you seed that industry? By offering tax deductions to Canadians. And again, what makes it sing, what's made it so successful is the GIC experience, is that liquidity provider we bring in that de-risks it. So what does the future hold for Canadian tech? I don't know. But I can tell you that it certainly works extremely well on the mining side, and it would be very exciting if it got brought into the technology side.
This policy shift is quite exciting, and it could be the missing piece of the puzzle for our domestic tech growth. To the tech founders and entrepreneurs watching, in 2026, capital is a bottleneck for every great innovation. And if Canada introduces flow-through for tech, it won't just be a policy update, it will be a massive influx for liquidity for our startup ecosystem. Please stop waiting for the VC markets to normalize. Get educated on how tax-efficient financing works now, because the business owners who understand this structure will be the ones winning the race for R&D funding. We'll take a quick break here. Don't go anywhere, because when we come back, we'll dive into how policy discussions like April 21 panel could reshape the future of venture funding in Canada.
Hey, you think you know UPS? Yeah, that's us. Everybody knows that. You know what you didn't know? This. Okay, try to keep up. Ocean, us. Ground, rail, air, so us. Guess who? Us. Customs cleared, borders cleared, done. Us. You still with me? Wait for it. Boom. Us. Intelligent, automated, fulfillment. Us. Yep. Healthcare too. Digital your thing? Yeah. Well, book it, ship it, track it. You feeling me yet? Yep. That's all us. That's all UPS.
Welcome back to the Canadian SME Small Business Podcast. Let's continue the conversation and explore how industry leaders and policymakers are working to close Canada's funding gap. Now let's look at how your April 21 panel tackles the future of venture funding and policy reform. Jeff, what is the key message for tech leaders and policymakers from your April 21 panel?
Well, I think there'll be a few key messages. It'll be different for everybody that's there. I mean, we're partnering on this, and we're obviously very excited about this because of the application for flow through into technology. But really, the event is also meant to be more broad based. It's going to be talking about venture capital, I think, in Canada more generally. It's going to look at what's worked in the past, what's not working now. Flow through is one solution of perhaps many that can be discussed, and it'll talk about just the challenges that tech leaders are having in terms of raising capital. I'm also equally excited about it because I think I'm a big believer in meeting of the minds and bringing people together and talking about these issues. This is a very unique event. I haven't been to a lot of events like this. In fact, there's been no events quite like this at least from a flow through technology standpoint. So we really are kind of on the cutting edge of that. So I think the key message is just innovation. We all know that our tech founders are innovating in terms of their own businesses, but this is tax as innovation, which I wrote an article about it a while back, thinking about tax as a form of innovation, because, we don't generally think of tax as an innovative thing. In fact, it's something that, there's two realities in life, death and taxes, and no one wants to pay tax generally, or, not more tax than they have to. Whereas I find tax quite exciting in the sense that because we all pay it, how can we use it as a lever to innovate and to build? And so I think that'll be one of the central messages, and just collaboration, getting everybody in the same room and bringing in the Ministry of Innovation, which I'm excited about. Just tackling this problem that we really do need to solve.
Creating this bridge between policymakers and private industry is exactly what's needed to really build a mature venture capital ecosystem here in Canada. Now, finally, Jeff, let's examine how execution and stability have positioned Wealth as a leader in major deal making. Please tell us what ensures long-term success in a complex tax and regulatory environment.
It's actually, it dovetails very nicely into what we were just talking about with the policymakers and the entrepreneurs and the business owners, because, like I said, this tax policy has been around since the 1950s. The structure side of things has been around for the last 20 years. But it's had its ups and downs. And I think that the real key to long-term success is just solid communication between policymakers and the business community. Flow-through shares don't seem like we're not going anywhere. It's a rock-solid tax policy. We need more of it. But often the message that we receive from a tax standpoint and tax policy is not always being optimized, because I don't think that the government is always speaking in tandem as much as they should with the private sector and what the private sector needs. And to give you an example, we all remember the increase in the capital gain with Trudeau and the shock waves that sent through the business community. That would have had a major impact on our industry from a flow through standpoint, simply because it wouldn't have made the tax policy viable anymore. So that's just an example of I just think that the CRA community, the tax community needs to be in lockstep with the business community. So when they create these tax policies, they're actually being optimized and they're actually being effective. I think too often people work in silos and aren't collaborating. And as a result, you're not getting optimal results. So I think the tech flow, for example, an event like we're having on April 21st is an opportunity, because it's an opportunity to get all those people in the same room and actually talk. And that just needs to be, I think, sustained in a more consistent and meaningful way.
Talking about consistency, I think that is the key. I mean, because this is consistency in a highly regulated field is a clear signal of your firm's deep expertise in market trust, Jeff. So thank you for highlighting that, ensuring its importance. This has been a great conversation with you so far. Thank you so much for sharing so much in a very limited time. As we wrap up now, what is your top advice for owners who are really seeking greater impact through smarter financial and philanthropic planning?
Yeah, I think just be curious. I think as business owners, it's incredibly important to know what the tools are that are out there. Flow through shares would be a great example, but this is a long-term tax policy, rock solid structure with a 20-year track record, 9 advanced tax rulings. So I think it's really just knowing what are the mechanisms out there for me to reduce my taxes, whether personally or corporately. And knowledge is power. So be curious, pursue all these options that you have available to you. Work with your accountant. That's really important. We work directly with the accountants and the financial planners. So, bring them in because that provides that comfort so you can optimize your strategy. And yeah, I mean, giving back in philanthropy is so important. It's incredibly important for the business community as well. We're firm believers that people buy products from companies that do something positive as well in the community. We're very firm believers in that. We're not just in the business of philanthropy, of helping our clients give more. We're very philanthropic as a company. And so, so I think it's just that curiosity. It's that being your own advocate and not just settling for the status quo. As tax might seem boring, but like I said, it's pretty innovative if you take that extra step.
That is a great reminder, Jeff, that with the right structure, you don't have to choose between growing your own business and changing your community. And this is a very well laid out response that you have put up across here, Jeff, in our conversation today. So we thank you again for coming down to see us in our studio and for sharing such great expertise.
Thank you. I really enjoyed it.
And that was Jeff Todd from Wealth, a masterclass on how to align tax strategy with high impact giving to shape a lasting legacy. Thank you so much for tuning into the podcast. Please be sure to subscribe and visit CanadianSME.ca for more resources. A special thanks to our partners UPS, Google, and ADP for their ongoing commitment to empowering small businesses across Canada.